Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. We hope you had a wonderful Thanksgiving, and thanks for being back with us. Coming up, a shorter holiday season this year means a bigger retail squeeze. Telsey Advisory Group CEO Dana Telsey is here to tell us how shoppers and retailers are juggling the holiday hustle and trends investors ought to be watching right now. Later, we've got a checklist of money moves to make ahead of the new year to get your financial house in order. But we begin with our expert panel and three big market moves that investors ought to be considering right about now. On the Barron's Roundtable, my colleagues Ben Levison, Elizabeth O'Brien, and Andrew Berry. So, Elizabeth, it has been quite a nice year in the stock market, but one sad area has been those poor healthcare stocks. They were having a lousy year, and then the election happened, and they went down another leg. What's going on?
That's right. Healthcare stocks have lagged. They are down about 8% for the month. And, you know, there's a lot of uncertainty in the sector. Investors are waiting to see whether Trump's pick for the health department will be confirmed. That's, of course, Robert F. Kennedy Jr., and his anti-vax stance has sort of rattled vaccine makers like Pfizer and GlaxoSmithKline, and also there are fears that he doesn't like the obesity drugs, and that has weighed on the makers of these like Eli Lilly and Novo Nordisk. But some that say the sector is oversold, and there have been recent upgrades like the German drug maker BioNTech.
Yeah, I mean, I agree with Elizabeth on the drug sector. It's been very much out of favor. You've got stocks like Pfizer, Merck, and J&J actually down on the year, and I think there could be some opportunities there. I'd point to Pfizer, which is near 52-week low at around 25. They got about a 7% dividend yield of stock, which looks pretty safe. I'd also highlight COVID vaccine maker Moderna, which is under 40 right now, down about 60% this year, with almost half its market cap in cash.
7% dividend sounds pretty nice. One of the few bright spots, Elizabeth, has been Humana. That's since the election has been a bright spot because of the idea that the Medicare rules might change that would help it in its favor.
That's right, Jack. There's some thoughts that a Republican administration will be more favorable to Medicare Advantage, which is, of course, the privately run alternative to traditional Medicare. That would benefit Humana, which is kind of a pure Medicare Advantage play. They might benefit from increased government payment rates next year.
Which is good for the stock. Could that be tougher on Medicare, patients?
Good question. That remains to be seen. All the plan details are set for 2025, so there will not be any immediate changes.
All right. On the other side of the ledger, Ben, it has been a fantastic year for Bitcoin, more than doubled this year. Does that keep on going? What do you think?
Well, and when you look at something like Bitcoin, you can't judge it by earnings because it doesn't have one. It's not a stock. And you can't judge it by the amount of interest it's going to pay you because it's not a bond.
Cash flow?
No cash flow. There's nothing there. I mean, it's really based on sentiment. And right now, the sentiment is great. Donald Trump's election win, he's gone from being a crypto skeptic to loving the thing. He's talked about having a strategic crypto reserve. And all this has caused crypto to go up. And you know, when you have something that's based only on sentiment, you got to look at the chart. And there's no resistance in sight. This thing can go 120,000. Why not?
How do you think investors should try to get their head around evaluation? I realize it doesn't have all those standard metrics.
I mean, I think you have to think of it like gold. It's something that you put in your portfolio that has a different way of moving around. You know, gold also does not have a stream of cash flow or anything like that, but it is a store of value. And I think you think of it, Bitcoin, like that, and you stick it in the same kind of sleeve in your portfolio.
So what about analog Bitcoin? What do you think about gold right here?
I mean, I like it. It was very strong until the election. I think part of what caused it to sell off is that people have, we're expecting there to be a long count of votes and maybe we wouldn't know who the president was, but it was over very quickly. And gold pulled back a little bit. Gold's always more of a bet on geopolitical uncertainty, political uncertainty, that kind of thing. It's done very well, though, not just recently in the past few years, but over the past 25 years, it's actually topped the S&P 500. I think it can keep going up.
And if deficit worries continue, people might see gold as a safe haven. Andrew, speaking of the long view, U.S. stocks have had a great run. A CIO I follow recently pointed out that over 17 years, the S&P 500 has beaten the MSCI by 320%. Is that going to keep going?
I mean, you can't really overstate just how well U.S. stocks have done versus those abroad for the last 10, 15, as you say, 17 years. This year's another poor year for international stocks. S&P 500 is up around 25%. One of the main ETFs that tracks international stocks, ticker IEFA, is up only around 4 or 5%. So the disappointing returns are continuing, and part of it has to do with the lack of big tech stocks in Europe and in Asia, as well as the Trump win has not helped because of the prospect of tariffs hurting those economies, and also the strong dollar.
So on the one hand, the playbook says reversion to the mean is very powerful at some point, that this huge delta between the two is going to close, so you ought to be an international. But then to your point, like I could buy a French retailer, but I'd really rather own the mega, the 7 mega cap stocks in the U.S. or in general, the innovation that's happening in this country. How do you get your head around that dichotomy as an investor?
Well, there's clearly less innovation in Europe and Japan than there is here. They don't have a Mag 7. There's maybe not even a Mag 1 or 2 over there. But you've got very low valuations there. European stocks are trading for about half the valuation of U.S. stocks, 3 to 4% dividend yields versus like 1% on the S&P 500. I mean, investors are kind of giving up on overseas stocks, which could mean that if you're a contrary investor, that next year may finally be a good year for them.
And if you do want to go overseas, what would you buy?
You can buy a group of ETFs like the IEFA. You can do the, for emerging markets, IEMG. And one thing that could be a help to investors in 2025 is the dollar may be peaking. It's been very strong this year, and that could go from being a headwind to a tailwind for American investors overseas in 2025.
That's a great point. One of the few years that overseas stocks did do better was 2017 as the dollar was falling. Thanks, Andrew.